Good afternoon, ladies and gentlemen. Welcome back to this week weekly market review. We have just finished the second week of the second quarter, and we also started the first week of the earnings seasons. And today I have with me Mr. Gerald Wong as usual to help us break down what has happened in the market in the past week. How are you, Gerald?
Well, there's been a lot of developments in the market over the past week, so that's been keeping us very busy in getting ourselves updated. I think a few that you mentioned was the inflation data that came out. Then towards the end of the week, we saw rising geopolitical tensions. But in the midst of all of this, we have the start of the earnings season as well. So quite a lot to actually understand what is driving the markets.
Yes, already we saw some of the banks in US starting to report, JP Morgan, Citigroup, and Wells Fargo, which did not meet the market expectation and hence some pullback in the US market. And of course, over the weekend, we had the Middle East crisis. So would you bring us up to speed on what has happened in the past week?
Yep. So before we start, just a disclaimer that today's sharing is for information purposes only and should not be taken to be financial advice. Okay, so given the significant developments in the market, we have a special edition of SIAS that is coming up this Wednesday, 17th of April. This is a free webinar for all to join. So if it is something that you're keen on, do scan this QR code to register. The registration will close today, 15th of April. So do make sure that you sign up for this if you want to be asking Sunny and myself questions during this Ask SIAS session. Okay, and if you find the weekly market review helpful, do leave us a review on Google with this URL as well. And to join SIAS as a member, you can go to this website. The membership for SIAS costs $1 per month or $12 per year. Okay, so what we saw in the past week was a correction, particularly in the US markets. The S&P 500 now reaching close to the 5,100 levels. So quite a number of developments that actually drove the markets down, and we'll share some of these reasons in the subsequent slides. Okay, the first thing that really disappointed markets was the inflation data that came out in the middle of the week. So what we saw here is that the US Consumer Price Index rose by 3.5% compared to the previous year. And this was above the market estimate for a 3.4% increase. So more worryingly, what we have seen is that over the past few months, inflation has actually exceeded market forecasts, and that is driving the view that inflation may actually remain persistent, and that will actually delay the Fed in its interest rate cuts. Okay, so that is what we see now in terms of the investor expectations of the Fed rate cuts. Okay, so effectively what we have here is the CME FedWatch tool and different probabilities that investors have assigned towards the interest rates. Okay, currently we are at 5.25 to 5.5%. But what we see here is that previously investors were expecting that it was likely the first rate cut will come through in June. But now looking at this chart, investors are expecting that quite likely the Fed will still keep the interest rates unchanged in the June meeting. Okay, and if I were to look at the course of 2024, it seems like investors are now just expecting there to be 2 rate cuts this year versus the previous expectation for there to be 3 rate cuts. Okay, so that is actually quite a significant change because if you recall, in the weekly market review at the start of the year, we shared that investors might be expecting as many as 7 rate cuts this year. Okay, so the expectations of the rate cuts have actually diminished very significantly as inflation actually come through way more significantly than expected. Okay, so likewise, that's what we see in terms of the expectations around the June rate cut. Effectively, what we have here is that previously, 1 week ago, investors are still expecting that we might see the first rate cut in June. But what we see now is that after the inflation data came out, investors are expecting that the first rate cut is unlikely to be happening in June because investors are largely expecting that the interest rate will remain unchanged in the June meeting. Okay, so with that, we have seen a jump in the US government bond yields. Okay, so this is the 10-year US government bond yield. It went up to close to 4.5% from about 4.4% a week ago. And this is really a reflection of the fact that inflation has come through way higher than expected. And with that, effectively, investors are moderating their expectations of interest rate cuts this year. Okay, so what do we see in terms of the Singapore market? We saw that effectively the Singapore market has actually held up relatively better compared to the US market. There were still a few stocks that did relatively well, such as Jardine Cycle and Carriage, Wilmar, Genting Singapore, and also notably DBS, given that banks are typically seen as beneficiaries if interest rates were to remain higher for longer. Okay. In terms of the worst performers, then what we see here would once again be some of the REITs, okay? Because again, if the interest rates were to remain high, there may be concerns about their financing cost, which is leading to the correction in some of the REITs once again. Okay, there's one question that we have commonly been getting, which is really around gold prices. So that is something that I wanted to share a bit more about today. So what we see here is that gold prices have now hit an all-time high, given that there are quite a number of factors that is helping to push gold prices up higher. Okay, so the question that we commonly get is what is driving this bounce in gold price and what should we do about it? Okay, so first and foremost, we can take a look at why investors look at gold. Okay, so a few reasons why investors typically look at gold, including the potential returns that it can generate, how it can help to diversify investor portfolios, as well as the fact that it is a very liquid market. So those are effectively why investors may actually be looking at gold. Okay, so one of the key factors that I mentioned earlier was about the returns that are generated. So this is actually a chart that shows the returns of gold versus different asset classes over the past 3, 5, 10, and 20 years. What we see here is that gold has actually done relatively well compared to some other asset classes, especially if we look at it from a longer term perspective. Okay, so if I were to look at it from a 20-year perspective, then effectively what we see here is that the historical returns of gold has been quite close to what we have for global stocks. Okay, so if I were to look at how gold has actually performed since 1971, then what we see is that it's increased by nearly 8% per year over this period of time. Okay, so that might be something that actually appeals to certain investors, given the historical returns that it has generated. But as usual, we'll have the disclaimer that past performance is not an indication of future performance. So then we can try to understand what are some of the key drivers of gold prices. Okay, so typically, if I were to look at what can move the price of gold, to me, it comes down to a few factors such as inflation concerns. Okay, so that is definitely top of the mind for me at this point in time. Next will be interest rates and central bank policies. Okay, so how the Fed actually reacts, where is the interest rate, can move gold prices as well. Okay. Next is something that is becoming more of a driver of the market, which is economic and geopolitical uncertainty, given the rising geopolitical tensions in the Middle East. So that is something that can affect the price of gold as well. There are some other factors such as US dollar speculative behavior that we can bear in mind as well. But for me, I will probably be looking at the three key factors, which is around inflation, interest rate, and central bank policies, as well as the degree of economic and geopolitical uncertainty to determine where gold prices might be headed next. Okay, so we start by looking at inflation. So we started today's session by sharing some of the higher than expected inflation data that's come out from the US. And what we see in this chart here is that there is typically a strong correlation between the returns of gold versus the US Consumer Price Index increase on a year-on-year basis. Okay, so during periods where the inflation is high, we see that the year-on-year increase in the CPI is more than 5%. That is typically when gold generates a higher average annual return. And when the inflation is low at less than 2%, then that is typically when the average annual return for gold is lower. Okay, so that is probably one of the key factors that is driving up the price of gold at this point in time, given that inflation is turning out to be a bit more sticky than previously expected. Okay, so effectively, this is what we see here. Inflation surprises has been positive. So inflation has been coming through more than expectations. At the same time, we see that the economic data is coming out to be maybe just slightly weaker than expected. So that is actually helping to move up the price of gold to an all-time high. Okay, the next point, remember I mentioned about how interest rates, central bank policy can also move the price of gold. So this is what we see as a longer term trend as well, whereby because there is a very significant increase in the US money supply, as shown in the purple line in this chart, with that, we have also seen the price of gold moving up with this increase in money supply. Okay, the last point is really around how gold is seen as a safe haven asset and has actually done well during periods of uncertainty. So if you were to look at some of the periods of previous crisis, whether is it during the global financial crisis, during say other periods, including COVID-19, then what we see here is that while global stocks might have had a pullback during this periods of time, given that gold is typically seen as a safe haven asset, we have seen that gold has actually performed well, if not okay, during these periods. And that is why some investors may view gold as a way to diversify their portfolios, given that the correlation with some of these asset classes may not be as high. Okay, so with this global uncertainty towards the geopolitical outlook, towards the economic outlook, what we have seen over the past 2 years is that central banks have increased their buying of gold. Okay, so if I was to look at the demand for gold and where is it coming from, then in 2022 and 2023, especially with the Ukraine crisis, central banks have actually come in to be buying up gold, probably because of the view that it is a safe haven asset. Okay, so really to summarize what we see across the three key drivers for inflation, it has moderated from the high levels of last year, but it is still at a higher level compared to the past. Okay. If I was to look at interest rates, the interest rates remain high, but what we see is that the money supply in the US has been increasing. For economic growth, so far we have not had any recession, but what we see is that the geopolitical uncertainty remains elevated. Okay, so with these factors, it is helping to push gold price towards an all-time high. Okay, so in terms of what to look out for in the week ahead, definitely the geopolitical tension is something that we'll keep a very close lookout for, whether we see an escalation in the tension in the Middle East. Okay, outside of that, we go into the full swings in the earnings season. After some of the US banks reported last week, we have more US banks reporting this week. And in Singapore, we also have some of the REITs starting to report their earnings, including CICT this week. Okay, And if you are interested in the Singapore Treasury bill, we have the 1-year Singapore T-bill auction that's coming up this Thursday. Okay. So with that, I'll hand over to Sunny, who will share with us more about the technical indicators and what to look out for. Over to you, Sunny.
Okay, I need to share my screen. Okay. Thanks, Gerald, for that coverage on gold, which is extremely useful, particularly when we are now seeing the increased tension in the Middle East again, which is the highest level since we saw the Hamas and Israel conflict that started in October last year. So before I go to the technical or the charts of the indices, I just want to give you a visual of what Gerald covered just now on the inflation rate as well. A single data point may not be a constitute as a trend, but now starting from this year in January, you can see that the inflation rate has been steadily rising for the past three data or three figures already. And that would mean it can constitute a trend now. And if this trend continue, the pullback in the indices or the markets is going to be more significant. Of course, the start of the earnings seasons that we saw last week with some of the major US banks reporting their earnings and did not really meet the market expectations, that exacerbated the pullback in the US market at least. And today in the Singapore market, in the STI index, we also see a 1% pullback right now. Okay, so we are now, STI is now resting on the 200 days moving average, 200 days EMA, that the exponential moving average that I'm using. I foresee that this downtrend is likely to continue further. Last week, we identified a support level around this zone. So this week, I will need to adjust this zone further down, and that my lower point would start from the lower bound of the Bollinger Band over here, which is this black line. And the current reading is now around the 3,164 points level or 160 points level. So let me just adjust this part over here first to a slightly lower level. Okay, so around here, that is where I am looking to get into back into the STI index. Of course, we still have this uptrend that you see connecting the low of December as well as the low of February and March this year. So this would be the trajectory of where I believe STI would hold up once it reached this level. So the first support level now is at the lower bound of the Bollinger Band, which is around 3160. And if it goes lower, we will retest this uptrend support line, which can reach around the 3,140 points level. So 3150 would be at an average of around this zone. That's the support level that I'm looking at to get on the STI index. So on the indicators wise, this week you can see that MACD has started to turn negative, and especially today, this negative momentum is starting to accelerate downwards with the divergence of the MACD line away from the signal line downwards. And if let's say we are going to cross the zero baseline, that pullback is going to be more significant. But if you look at the previous trend, at least for this year, the MACD line and the signal line, usually when it trends towards the zero baseline, it starts to get a bit of support and start to rebound back. And if that's the case, nearer to the zero baseline is where we need to keep our heads up and look for any signs of the changing of direction from the MACD on the signal line. And that could coincide with the 3160 or the 3150 level or the support level that we have identified over here. On the RSI, we can see that last week we breached below the 14 days RSI moving average level. And the latest reading as of last Friday, we have the 45 points, this morning, Monday, we have the 45 points reading already. So it's below the 50-point neutral mark, and the trajectory of the RSI looks set to be coming down further, which ties into what the MACD is saying, which ties into what we are likely to observe on the charts to go. The STI is likely to pull back a little bit further to the 3160 or 3150 level. So if that is true, then we will want to look out for the 30-point level, which is the oversold level, where we usually, when we touch that point over here, especially if I bring out this point over here in October, you can start to see a very strong rebound happening. So let the RSI get closer to the 30 point before we get back into the STI index. So these are the indicators, the levels, the momentum reading from MACD and RSI that you can take reference from for judging your entry or timing your entry into the STI index. Next, let's move to the US indices. US indices, as you can see, the Dow Jones Index is the one that suffered the most in the past few weeks, of course, exacerbated by the US bank earnings, which is a big component of the 30 stock Dow Jones Index. So we are now touching or using the lower bound of the Bollinger Band as some kind of support for the Dow Jones Index. We have also tested the 100 days moving average, which is the amber line that you see here. So in my opinion, this is actually a good level to get back into the Dow Jones Index as for now. Previously, we identified the 50 days moving average, as you can see, once the earnings season comes out, and then of course on top of the unforeseen escalation of tension in the Middle East, it has actually presented a much better opportunity over here where we are testing the 100 days moving average. Of course, are we going to see a immediate rebound from this 100 days moving average, just like we see on the 20 days moving average in the past 3 months where we test this 20 moving average level? I do not think we will see a immediate rebound that we are going to observe. We are going into the earnings seasons with more banks going to announce their earnings this week. We will have to keep a close look on that. But at least on the indicator side, there is still no signs of a reversal in sight, meaning the MACD indicator, the MACD line and single line are both trajectorying downwards. So meaning that trajectory, that projection is still likely to go downwards. But I believe the 100 days moving average should hold on to as a support level for now. So this would be the pivot level that we are looking at around the 37,860 point level. Let's say if the RSI go and went below the 30 point oversold mark, that would be another indication of a rebound that's likely going to happen. But as of now, last Friday reading at 33 is still not at that level yet for the Dow Jones Index to do a reversal or a rebound. So I think we still have to wait a couple more weeks before we get the indication of a confirmed oversold scenario and probably any change in direction or trajectory of the MACD indicator before we see a rebound in the Dow Jones Index. Next, let's move to the broad index S&P 500. So this is the level that we are talking about, the blue color line, which is the 50 days exponential moving average or the 50 days moving average if you are using the simple moving average. So this is the line now, which is at around the 5,093 points level. The S&P 500 closed at 5,123 points. So we are getting very close to this level. The lower bound of the Bollinger Band at 5,119 also did provide some support for the S&P 500 last Friday, and hence around this level you will find the confluence of both the lower bound of the Bollinger Band with the 50 days moving average that will provide some significant support for the S&P 500, hence a possible area that you can consider to load up on the S&P 500 index or ETF. But if you look at the indicators wise, although the momentum is still very choppy, but the direction has been pretty clear, at least for the past week, for the past 5 trading sessions. We are still on a downward trajectory, and last Friday we actually have an extended or a more aggressive downwards divergence of the MACD lines against the signal line downwards again. So the course is not very clear right now. So we still need to wait for at least, I would say, the S&P 500 to test the 50 days moving average, meaning we need to breach the 5,100 points level before we can see whether there is any turning point or any strong support level or liquidity coming in. If you look at the RSI, we have also just reached the 50-point neutral mark. So that means that momentum is very weak right now. How far it will go down, we are not sure, but definitely we are not going to see an immediate rebound. So that means that probably we would be trying to be range bound using the 50 days moving average for the S&P 500 as a pivot point for now to see how it will develop in the next couple of weeks as the earnings seasons unfold. Okay. Lastly, let's go to the tech-heavy NASDAQ Composite Index. Now, if you compare the 3 indices, I will just go through them again. Dow Jones Index, you see this pullback. S&P 500, you see this pullback. And then the NASDAQ Composite Index, the pullbacks is actually much milder, largely because the performance of the tech stocks is still very strong. So that means the NASDAQ Composite Index is not as much affected as compared to the Dow Jones and the S&P 500 index. So the 20 days moving average continues to be a pivot level for the NASDAQ Composite Index, although we closed below that last Friday. We could be getting closer to the lower bound of the Bollinger Band at 16,013 points, or even just slightly below that, the 50 days moving average in blue at 15,980 points. That is the point that I will load up again on the NASDAQ Composite Index. Okay, so these are my opinions. Hence, on the indicators wise, we can see that momentum has been moderating. I would say not very aggressively changing in direction, but has been moderating since the past 1 month, I believe, at the beginning of March. So that could mean that we could also be stuck in a range bound kind of situation in between the upper bound and the lower bound of the Bollinger Band for quite some time. So a bit of a directionless kind of feeling on the Nasdaq Composite Index, with it's now slightly negative below the 20 days moving average. The RSI is right smack in the middle of the very close to the 50-point neutral mark. The last Friday reading was 49. Hence, that also coincides with the point that I mentioned just now. We don't have a very clear direction on the Nasdaq Composite Index, and likely it will be range bound within a tight or narrow range of the upper bound and the lower bound of the Bollinger Band. So if you are into tech stocks and you want to get in on the Nasdaq Composite Index, do wait for the 50 days moving average to be tested, or even the lower bound of the Bollinger Band to be tested before considering an entry. And when that happens, do double check with your indicators to see that if there's any signs of a rebound in sight in the momentum, that would give you a better entry point on the Nasdaq Composite Index. And that is all that I have to share this week. Any more key things that we need to take note, Gerald?
So quite a number of things to look out for, including what we have for the geopolitical tensions. We have got the earnings season that is coming up as well. So those are some of the key things that I'll be looking out for. And if you have any questions about some of these indicators, market trends, company updates, do join us in the upcoming SIAS session this Wednesday, where Sunny and I will be happy to help answer some of these questions.
Yes, I do look forward to everyone watching this weekly market review today, to see you on Wednesday to have a chat and answer some of your questions. Of course, the Middle East crisis is brewing, but with every crisis come opportunities that you should be able to grab and seize or during this time of uncertainty. And of course, as usual, do remember to trade safe and stay safe, and keep a close watch on the markets and the developments. And we will see you again next week in the next weekly market review.
Thank
Thank
you.
you.